So this idea of being of two minds, with inflation being a real thing, things are getting more expensive. I've heard from a lot of people I trust, and again, it's kind of evenly split down the middle, where they're like, "Hey, inflation is really going to take its toll on the overall economy. You can pick any asset, crypto. I've got a block of silver in my safe, or I've got a house that I own, or I've got an antique car. These are not things that I own, but I'm just saying, if people have these assets that have inflated in value, like half the people I hear from are like, ooh, sell the assets, have some cash, have some dry powder, because inflation's going to end up having, bad bad effects on the market, and this inflation is not as transitory as we think it is going to be, and you want to have some cash for dry powder to invest in Atom or buy platinum Rolexes when they're on sale or whatever, because that's going to happen in the near future. And then like the other half of people are like, screw it, I'm leveraging myself to the hilt. I'm buying another property. I'm buying more, pick an asset, bar of silver, crypto, art, classic cars, because the inflation in the market and what we're doing with kind of printing money in the United States is just going to continue to make prices rise for the foreseeable future. So I guess that's a very long-winded way to say, can you explain to people, maybe the novice that's watching this, what inflation is, why it matters or maybe doesn't matter, and then do you have any opinion on what people should do about it?
Sure. So what is inflation? Inflation is too much money chasing too few goods. That's like the econ 101. So when you have a lot of money in the money
And
supply,
we lost your mic a little bit. I don't know if you leaned in the computer
oh,
or something, but we lost your mic a bit.
maybe, sorry about
That's
that.
much better.
So
Yeah.
inflation is too much money chasing too few goods. That's the economics 101 definition of inflation. And it's it's not necessarily a bad thing, but it's a bad thing, for example, if you're holding fixed income assets.
And what does that mean? Explain to the
So,
novice what fixed income assets
yeah,
are.
yeah, a fixed income asset is like a CD or a bond that has a stated yield. So, right now, yields on bonds are really very, very low, um, historically low. And usually, that you can think about the yields on bonds as somewhat correlated to interest rates on mortgages. So, like, if you're able to get a really low mortgage at the bank through a bank or a lender, you're also likely to not be making much money on your checking and savings accounts,
Right.
right?
Right.
So there's a correlation there. So there are assets that are better hedges against inflation than other assets, and some of those assets, if you want to stay in the fixed income, like if you're just afraid of the stock market, you can get investments that have some inflation protection. They're called TIPS or MIPS. Um, Basically, they're fixed income investments that have like an inflation kicker, let's call it. So, but I mean, historically, the best hedge against inflation is owning stocks, owning companies. So I think it's fine to have like different, hey, a part of me feels this way, a part of me feels this way. What's most important is that when the stock market goes down, that the part of you that felt like, oh, I know the stock market's going down, doesn't all of a sudden say, see, I told you you shouldn't have had the money in the market, because that's what people do, and then they bail out. And I mean, there's really, really strong research to support that 5 years ago the US stock market was overvalued.
Right. Right.
Very strong research to support that. And if you had said, oh my gosh, it's overvalued, what you would realize is that really clearly is that there's two things that drive stock prices: the underlying fundamentals and the speculative effect. So the speculative effect is how much people think a company is worth, whether it's worth that today or not, right? Like when you look at a company like Tesla that has $1 trillion market cap and is $1,200 after it's split 5 times. I mean, it's you look at the market capitalization, which is the number of outstanding shares of stock times the stock price, and that's supposed to represent the size of the company. But then you have a company like Rivian, for example, that does an IPO, and with having produced 20 cars,
Right.
they suddenly are a bigger company than Volkswagen. Or I'm giving some examples.
Right.
Ford, like, that have billions of dollars of revenue. So how you make sense of that is recognizing that in the long term, when you buy a stock or when you buy the stock market, when you buy a broad index, you're buying future earnings. And it might not be that those earnings are going to come next year or 5 years. Like, was it intelligent to buy Amazon stock 20 years ago? I mean, then you might have said, well, geez, they didn't have any profit.
Yeah.
That,
Didn't
right?
Amazon lose money for like their first 11 years of existence? I mean,
Yeah,
theoretically, the company is worth negative dollars in current valuation, but people were driving up the stock price, seeing the future value, and
correct.
somehow Jeff Bezos threaded that needle where he went from like, oh yeah, Scott wants to buy a book for $19.99 and doesn't want to drive to the store, to now Amazon is completely intertwined in every fiber of our being, our family,
Right,
our everything. So I mean,
right.
they're the rare company that threaded the needle of like showing up to that future value stage, and they did it, and it's amazing. But I'm guessing, back to your Tesla example, if we're defining the market cap by all the outstanding shares of the company times the value of the share, and that means Tesla's worth $1 trillion. There's no company out there who would pay $1 trillion for Tesla, because Tesla's not making anywhere near that much revenue or profit, right? Am I reading
Correct.
the tea leaves
Correct.
correctly here?
No, that's correct. That's correct. It's just, people think, oh, well, Elon Musk is a genius and Tesla's going to be the next Amazon. Whatever company is going to be the next fill in the blank.
Right.
And so they want to be in early, and they're willing to invest in the company, even though that company might not have profits. And what's really interesting and kind of a paradox is that once a company has profit, it's a lot more easy to value the company.
Right.
So now you really know, oh, the company has profit. Now I can value it more clearly. And now I can see, oh, it's worth, it's 100 times earnings. It's 200 times. No way, I'm not going to. But when it doesn't have any, the PE ratio is the price of the stock divided by the earnings. And when there isn't any positive profit, when there isn't any earnings, you don't really have a PE ratio. So it's nebulous, and that often leads to people speculating, sometimes really well, but sometimes, huge losses
Right.
as well.
Right.
And so those are, kind of like when people go to Vegas, and I don't like to use Vegas examples because investing in the market is very rarely like gambling, but it is when you pick an individual stock that doesn't have any, that doesn't have any earnings, that doesn't really have any infrastructure. All you're doing is you're betting that they're going to at some point in the future, whenever that is.
Right.
So because there are the two pieces that drive up the markets, the underlying fundamentals and the speculation, that's why, people, you can't outsmart, so to speak, the market. And, really, really smart people, oh, well, I saw that housing starts are up. Oh, I saw that unemployment's down. I saw that the speculative effect of the market is real. And so over time, yes, those things matter. But in the short run, they may or they may not matter.